If you buy a property in a super fund, if it's residential, you can't live in it, you can't, your mates live in it, it's prohibited. Yeah? But if you buy a commercial property or a business property in a super fund, you can.
So yes, a great strategy that we see with business owners and want to own the property or the premises in which they operate. Having it owned by their SMSF is a great investment strategy.
Now, this is really important to understand. Buying property in an SMSF will not save you on tax.
When you own a property inside your SMSF, there is a bit of a misconception that it will save you money on tax, on your personal income tax, which is not actually the case.
Dutton has said that a solution would be to allow people, Australians, to take out $50,000 from their superannuation.
This is so bad.
Oh my God, Albanese, please save me. Welcome to SMSF Insider, where we help busy professionals to gain financial independence using an SMSF. Hi, I'm Troy, founder of Blue Chip SMSF Services. And over the last 20 years, I've helped thousands of Aussies manage the complexities of self-managed super funds. And in this podcast, I'll answer your questions, break down the myths, so you can take charge of your financial freedom. Let's get into it. Hi guys, and welcome to this edition of SMSF Insider. Today I'm going to be looking at some social media content and giving my opinion on what I see and hear.
Australia's worst performing and highest fee superannuation funds have just been revealed in APRA's annual report. And amazingly, these funds hold over $10 billion of Aussie superannuation money. Of the funds analysed, they found that 4 were delivering negative returns over the long term, which is insane in the current market environment. 48 of them are stinging customers with significantly higher fees, and another 80 are performing, and I quote, very badly.
We see this a lot, underperforming super funds. There are a lot of them out there. So that's why it is important to check your returns and make sure your asset allocation is in line with your investment goals. So check the portfolio you're invested in, make some changes if you need to, speak to your advisor, speak to somebody who can help you, but don't just sit there and accept negative returns in an environment where negative returns are just non-existent. The market has done pretty well, so you certainly should not be paying fees for negative returns. So speak to your advisor, get some help, and make some changes.
If you buy a property in a super fund, if it's residential, you can't live in it, you can't, your mates live in it, it's prohibited. Yeah? But if you buy a commercial property or a business property in a super fund, you can.
Yeah, exactly right. So if you own a residential property in your SMSF, you cannot live in it. But if you own a commercial or industrial asset inside your SMSF, your business can lease that asset or that property from your business, and your SMSF can collect the rent on a weekly, fortnightly or monthly basis, as long as it is not higher than the average market rate or lower. It needs to be in line with the market rates. So yes, a great strategy that we see with a lot of clients, self-employed clients, that are business owners and want to own the property or the premises in which they operate. Having it owned by their SMSF is a great investment strategy.
How dare the government take 10% of people's income without ever asking them and forcing them to give it to someone they've never met? Now, why can't we do what New Zealand did? New Zealand had a referendum on whether or not superannuation should be compulsory, and you know what they voted? They voted against it 92% to 8. We're not supporting investment in Australian assets. Well, there's already $600 billion invested offshore. There's already $600 billion invested offshore with superannuation. And I've got the clip when Bob Hawke said that superannuation was going to be used to invest in Australian manufacturing. Well, that never happened.
This particular guy is saying that 10% of everybody's wages is taken out without even asking and invested offshore. Well, it's not really the case. The 10% or 11.5% is taken out. It's on top of everybody's salary. So the employer, it's an employer expense, not an employee expense. And then it is invested according to the mandate of each superannuation fund. So I think that certainly Australia wouldn't be in a very good space if we didn't have the superannuation system. So it does actually work. It just needs refining. And certainly from what he's saying here, that the 10% is taken without anyone's authority. Well, that isn't actually the case. It's it's taken on top of everyone's salary and it's paid for by the employer, not the employee. I think what he wants to do, what he's saying is he would like to see all of those funds invested here in Australia, but I just think that the Australian market is so small compared to the rest of the world that the amount of money in the superannuation system, which is now in the trillions of dollars, if it was invested in the Australian market, I mean, where's it going to go apart from ASX listed companies? It's all that's going to do is inflate the value of those companies and overvalue them. So, and from a risk mitigation perspective, I think having funds invested overseas in certain countries is not a bad option. It's not the be all and end all, but certainly you want a little bit of diversification outside Australia because after all, it is a very, very small market. Just quickly, guys, if you're a busy professional, fed up with traditional super funds and overwhelmed by the setup of your SMSF, we can help. Book in a call with my team using the link in the show notes and let's build your future on your terms. Now, back to the episode.
Now, this is really important to understand. Buying property in an SMSF will not save you on tax. When you own a property in a self-managed super fund, it's owned by the super and it's tax deductible to the super fund. It's not taxed.
Yeah, so what Nicole is saying here is that when you own an SMSF, when you own a property inside your SMSF, there is a bit of a misconception that it will save you money on tax, on your personal income tax, which is not actually the case. So purchasing property will only save you on your personal income tax when you purchase that property in your own name, which is not what happens when you purchase a property through your SMSF. So what Nicole here is saying is actually correct. So if you're wanting to save money on tax, with your personal tax, then you need to perhaps speak to somebody about purchasing assets in your personal name or the entity in which is receiving an income and paying income tax. The SMSF is a very low tax structure, so it will have its own tax deductions, but certainly because it's a low tax structure, it's not going to be paying a lot of tax, generally speaking. But certainly Nicole is correct. And buying an SMSF, or buying a property, I should say, inside your SMSF will not save you on your personal income tax. That is a separate strategy altogether.
One of the Lottos has jackpotted to $70 million. If I was to win it, not that I've even got a ticket in the competition, but if I won the Lotto, this is what I would do with the money. So if I start with my $70 million up the top here, I would use $5 million of that to pay off my mortgage, buy a holiday home, buy some cars, buy some toys. I would use some of the money to give to family to help them pay off their mortgages, top up super, those kind of things. Then I would use some of the money to contribute to superannuation for my wife and I. We don't yet have a self-managed super fund, but I would start one given the money here. Given the time of year, we'd put $120,000 into superannuation each now, just before the end of the financial year, $360,000 in the new financial year. That's a combination of $480,000 each added to super. Roughly $1 million goes into super on top of the balances that we currently have. I would set up superannuation funds for my children. Both of my children are in primary school. They do not have super funds just yet, but I would set up super funds for them and I would do the same thing for them, $120,000, $360,000, get $480,000 into superannuation for them now whilst they're in primary school, which means that no matter what happens in their life, their retirement's going to be pretty set for them. James
Wrigley is referring to here when he's talking about the $120,000 in this financial year and then $360,000 in the next financial year, is he's talking about non-concessional contributions. So with self-managed super fund or with any super fund, you have there are two types of contributions: a concessional contribution and a non-concessional contribution. The current cap for a non-concessional contribution is $120,000 per year. But what you can do is roll forward 3 years. So he's saying he put $120,000 in this financial year for him, $120,000 in for his wife. He'd then wait for the next financial year to roll around, and then he'd put in another $360,000 each, which is 120 times 3, so 3 financial years. And then he'd do the same for his kids. So he's he's referring to mostly around the non-concessional contributions here. A great strategy if you've won 70 million or you've won any sort of money, you get any sort of windfall, inheritance, that type of strategy, topping up your SMSF or your super fund with both concessional and non-concessional contributions is a great way to beef up your fund and get it working for you sooner rather than later. Also, in addition to those concessional or non-concessional contributions, it's pretty important to, if you won 70 million or you get a big windfall like that, you probably want to get your structures right first. So maybe speak to your accountant or advisor around getting your structures right, being a family trust or whatever structure you choose or your advisor helps you with. And then from there, then you can go forward and do your investing out of there. But pretty important to get your structuring right up front.
Dutton has said that a solution would be to allow people, Australians, to take out $50,000 from their superannuation.
This is so bad. And we know what happens.
Yes, we
because
do.
Look at New Zealand.
Look at New Zealand. Look across the ditch.
It's a disaster.
It's a disaster.
What happens is that prices go up. And it doesn't assist people into home ownership.
No.
And people end up with more debt. They end up with less retirement incomes. And it has a particularly bad impact on women.
Oh my God, Albanese, please save me. Yeah, look, I don't think it's a good idea allowing people to withdraw money from super, but please spare me with Albanese's responses and advice around what's going to be best for Australians. I don't think Division 296 is very good for Australians either. So, yeah, I don't think that withdrawing money from super is a great option for home ownership, is really going to help with the housing affordability. And I certainly don't think that Albanese's advice is something that most people are going to listen to when you've got a guy here that's just introducing unrealised capital gains tax to super funds. And then potentially, where does unrealised capital gains tax go to next? Probably assets outside of super, who knows? But certainly, Albanese, spare me, please. Guys, thank you for listening to this episode of SMSF Insider. It's been a great and fun episode, and really looking forward to the next one. If you have any comments, please drop them in the comment section below, and also let us know if there's something you want us to talk about in future episodes. We'd love to hear your feedback and would love to generate some content that you guys want to hear about. So thanks again for listening. Thanks for tuning in to this episode of SMSF Insider. If you got value from this, make sure you subscribe so you never miss the strategies we share to help you take control of your financial future. Find us on socials at Blue Chip SMSF or book a call with our team to see if we can help you.